Introduction to investing. Investing is a powerful tool for building wealth, achieving financial goals, and securing your future. For beginners, the world of investing can seem complex and intimidating, but with the right knowledge and approach, anyone can become a confident investor. This guide aims to provide a solid foundation for new investors by explaining key concepts, strategies, and tips to get started. Whether you're saving for retirement, a major purchase, or simply looking to grow your money, understanding the basics of investing is an essential first step. Understanding investment types. Investing involves putting your money into assets with the expectation of generating returns over time. The most common types of investments include stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate. Stocks represent ownership in a company and offer potential for high returns but come with greater risk.
Bonds are loans to governments or corporations that provide fixed interest payments, making them less risky but typically offering lower returns. Mutual funds and ETFs pool money from multiple investors to invest in a diversified portfolio, reducing risk through diversification. Real estate investments involve purchasing property to generate rental income or capital appreciation. Each investment type has its own risk-reward profile, so it's important to understand how they align with your goals.
The importance of risk management. Risk is an inherent part of investing, but managing it effectively can help protect your portfolio and maximize returns. Diversification is one of the most important strategies for reducing risk. By spreading your investments across various asset classes, industries, and geographic regions, you minimize the impact of poor performance in any single area. Another key principle is understanding your risk tolerance. How much risk you're willing and able to take based on your financial situation and goals. Younger investors may be able to take on more risk due to their longer time horizon, while older investors might prioritize stability. Additionally, setting realistic expectations and avoiding emotional decision-making are critical to long-term success. Building an investment strategy. A well-defined investment strategy provides a roadmap for achieving your financial goals. Start by identifying your objectives, whether it's saving for retirement, funding education, or building wealth over time. Next, determine your time horizon, which influences the types of assets you should invest in. Short-term goals may require safer investments like bonds or cash equivalents, while long-term goals can benefit from higher risk, higher return assets like stocks. Regularly contributing to your portfolio, known as dollar-cost averaging, can help mitigate the impact of market fluctuations. Finally, periodically review and adjust your portfolio to ensure it remains aligned with your goals and market conditions. Final thoughts and next steps. Investing is not a one-size-fits-all journey. It requires careful planning, continuous learning, and disciplined execution. Begin by educating yourself about the basics. Then take small steps to put your knowledge into practice. Consider opening an investment account with a reputable brokerage platform and start with small, manageable contributions. Leverage resources such as books, online courses, and financial advisors to deepen your understanding. Remember, investing is a marathon, not a sprint, and success comes from consistency and patience. By starting today and staying committed, you'll be well on your way to achieving your financial aspirations.